Hello there. Welcome to the Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. TELUS has hired TD and Jefferies as advisors to aid in a review of its TELUS Health operation. The company says the hiring will help develop strategies for monetizing the asset. CEO of TELUS says the focus for TELUS Health is finding a strategic partner. Lundin Gold says it has found a potentially world-class copper deposit in southeast Ecuador. The CEO told reporters that the deposit was found in an area which has the ability to rival other copper hotspots, including Peru and Chile. The company is now figuring out next steps. It does say that development will need extra studies. Shares in defense stocks rising after U.S. President Donald Trump says he's planning to request an increase in the U.S. military budget. U.S. companies like Lockheed and Northrop Grumman saw a boost, along with European defense shares. The proposed increase was announced by the president on Truth Social, and it proposes a $1.5 trillion U.S. defense budget for 2027. U.S. futures wobbling a little bit. We did see some weakness in the big tech stocks. U.S. shares, like Canadian shares, ended yesterday just off this week's record high. Let's have a look at how the TSX traded yesterday, losing about 1%. Let's check in on gold. And gold is... oil first. Oil above all else. Oil up something like 2%, north of $57 right now. Let's have a look at gold. Gold seeing some selling again, and we did post big losses for some of the silver stocks in Toronto yesterday. Let's check out the Canadian dollar. And it is slightly down, but barely, against the U.S. currency. And finally, Bitcoin, the biggest crypto. And that one down around 1% right now, going below that $90,000 psychological level. Lots of geopolitical noise out there. Trump capturing the Venezuelan leader, and also raising questions about the future of NATO amid this controversy over his desire to annex Greenland. But our guest says AI is still the number one topic with a lot of clients. We're joined by Grant White, portfolio manager and investment advisor at Endeavor Wealth Management. Grant, great to see you.
Hey, great to see you too, Andy. Happy New Year.
Happy New Year to you. So the clients, when you talk to them, AI is top of mind for many of them?
You know, it's funny. I wonder if it's just people are just becoming numb to the geopolitical stories that are going on out there, because it's pretty constant these days. But yeah, I mean, I think still the conversations are largely around AI. And a lot of that is market driven. I mean, what we've seen in the last couple of years, obviously, has been driven by the AI the AI story and the theme, and that has continued on. And so I think that's still very top of mind for people as they're considering more valuations than anything else and wondering, what comes next. And so although the geopolitical risks, I think, are certainly there, and we're going to see volatility this year, it's certainly something that we're following very closely. The questions we get a lot still around are job displacement, and what does this mean for certain companies, and what does this mean if certain companies don't do as well as they have in the past, and so on and so forth. So I still think that's very top of mind, which somewhat makes sense given what we've seen in the last year to 2 years.
And what do clients say? I mean, I presume some of them have made lots of money on these AI stocks. Are they saying, Grant, should I get off the roller coaster now?
Yeah, well, it's certainly that is like, can we keep this going? Is this going to continue on? Like, Grant, you've been a genius over the last couple of years. Are you still a genius going forward? You're right. I mean, certainly is a lot of that is like, how long can this go? We're at record highs, or is this a bubble? Is what does this mean? And a lot of the conversation we have around that relates to diversity in the portfolios. I think that's that's something you need to be very strong on today. Is that one, I think holding quality names in a diversified portfolio is going to be really important in 2026. But I also think you're going to have to look for the names that are lesser known out there in order to get good returns this year. I mean, I think the easy money's been made. I think it's going to be a lot harder for the big names that we've seen perform very well, the Amazons, the Alphabets of the world, to continue to perform at the high rate that they have or just on a share price basis. And so I think you're gonna have to look for the lesser known names in a year like 2026 and see where you can find that growth going forward.
You have some stock ideas for us that you say are value oriented. Start off with Mercado Libre, which I believe is the Amazon of Latin America.
Yeah, that's correct. So Mercado Libre is it's just a fantastic business. And I think if you like Amazon, if you love Amazon, you should really like a Mercado Libre, because it's a very similar business. Now, the difference is they're based out of Latin America, and they have all of the infrastructure built out. So, and Amazon would love to come into the places that they operate, but it's very hard. I mean, there's a lot of moats built and fences built up, and they're not going to be able to, I mean, Mercado Libre is established. So for all the reasons that you like an Amazon, you like a Mercado Libre, but you like them even more because from a pricing perspective, they're just that much better off. They don't have the same expectations that have been built into it like Amazon has. And so you can get it. I don't know if a value is a correct way to say like they're a pure value stock. I don't think that's the case, but they are value at a reasonable price, or a growth at a reasonable price, I should say. They're a high growth company, looking at annual revenue growth over 25 to 30% per year. And so we expect that this company is going to produce, 50 to 60% in overall gains in the next few years for us. And I think that, based on what we're seeing from them, that's a very likely scenario.
You have a New York listed company, CNX Resources. What has caught your eye there?
Yeah, this is, again, on the AI theme, I mean, energy is obviously one of the big conversations we have on a regular basis with clients, actually. And so CNX Resources is a very interesting company to us because, again, it's a lesser known name out there. One of the things that I love about this company is, their management, their market position is also fantastic. They're more of a midstream. They control like the early and midstream of the energy production. They're located in Pennsylvania, and so they've got their geographic location is actually really strong, really perfect for this. And they've shown that they can manage through pricing issues, and still generate strong free cash flow. And I think they've got 23 straight quarters of free cash flow growth going on right now. So overall, the company is very strong. Management's been very strong. Again, I just expect that they're going to be able to continue to do well as energy demand continues to increase. And especially on the natural gas side, I think CNX is going to do very, very well.
And finally, a Toronto-listed name, Cipher Pharmaceuticals. Their specialty is niche drugs. What draws you to this one?
So Cipher is just, again, on the theme of looking for lesser known companies that you can find great value in, Cipher is a really good example of this, because out of all the pharmaceutical companies, you're looking for, like, people would be aware of, Cipher's usually not on that, on a big list. And part of the reason is they're not focused in on the big drugs that everybody else is, like, that you'd see commercials for. I mean, this isn't a company that's going to be producing like an Ozempic or something like that. They don't get into the mud of like of funding big research budgets and so on. What they're very, very good at is identifying niche drugs around things like, like skincare and acne and things like that, that are a high need, but just not high priority on the big list of drugs. And so they're able to squeeze out very nice margins on higher volume products that are just lesser known. They're also very good at structuring. So for example, they're very interested, rather than getting into research projects, they're more interested in buying up something where they can license it out to American companies, and those American companies can then go and sell it for them. So they're just essentially clipping the margin in those types of deals. So overall, overall, I'd say, again, this is more of a very strong play from a strong management team. They've been very good at this for a long time. And if you're looking for a good company that's somewhat lesser known, you can find good value. And I think Cipher is a very, very strong company in that space. And again, good, strong year-over-year revenue growth, and we expect that we're going to see a 40 to 60% share price appreciation sometime in the next 5 or 6 years, perhaps, on that one.
Grant, thank you very much indeed.
My pleasure, Andy. Always a pleasure.
Grant White, portfolio manager and investment advisor at Endeavour Wealth Management. Coming up, the beer giant Constellation Brands is one of Berkshire Hathaway's investments. Now, that stock's up in the pre-market after a revenue beat, but it has slid more than 30% in the past year. We'll talk to an analyst after the break who sees upside for this stock. Constellation Brands is a gigantic player in the U.S. market. It's a distributor of Corona and Modelo, the biggest selling beer in America. Now, it beat on fourth quarter revenue expectations, even though revenue was down year over year. Warren Buffett's Berkshire Hathaway began buying this stock in 2024. The shares are down more than 30% in the past year, or they were as of yesterday. We're joined by Filippo Falorni, Director, U.S. Beverages at Citi Research. Thank you very much indeed for joining us, Filippo. It's always great to talk to you. Can you just remind us, Constellation Brands, it's so interesting, they are the biggest beer company, or at least they have the biggest single beer in the American market.
Yeah, great seeing you, Andy. Happy New Year. Look, Constellation is one of the leading beer brand manufacturer in the U.S. As you mentioned, Modelo Especial 2 years ago became the #1 selling beer in America. Obviously, the last year and a half has been particularly challenged for them, given the weakness in the Hispanic consumer base. Remember, Hispanic consumers are around half of their business in terms of consumers. And clearly, since the inauguration of President Trump and the changes of the administration on immigration policy and the ICE raids that we've seen across the U.S., there's definitely been some negative impact on Hispanic consumer sentiment, on their willingness to go out and interact and have social interaction, going out to bars and restaurants. That has negatively impacted the beer business. And you've seen it, as you mentioned, in the negative stock reaction. This quarter that they reported last night was another challenging quarter overall, -3% depletions, which is a measure of volumes. But it came in better, to your point, than expected by the market. So even though it was down year over year, the declines was less than feared, and that's why you're seeing the stock react positively in the pre-market today.
And what is your actual rating right now on Constellation?
I have a neutral rating on the stock. Look, I'm a big concern on these dynamics in the beer industry. Beer overall as a category is under pressure, given younger consumers are drinking less. There's been a shift into other drinking options, including ready-to-drink spirits and cannabis-infused beverages. And then you have some impact also of GLP-1 drugs, that people that are taking those drugs are significantly drinking less. And then the other thing is this Hispanic consumer malaise has been going on now for over a year. The big debate is, can it stabilize in 2026? And so those headwinds become less on a year-over-year basis, or could we see continued pressure this year? That's ultimately, I think, what is going to determine the outlook for the beer business and ultimately for the stock.
It looks like you're not that crazy about the beer business right now, Filippo, in the sense that I think you have a neutral rating on both Molson, Coors, and Boston Beer.
Correct. Look, I think overall beer has been definitely a sector that is under pressure, as I mentioned, in terms of consumer preferences, in terms of overall volume trends in the category. I do prefer the energy drink space in the beverage category, given you're seeing really younger consumers increasingly going for non-alcoholic options. Alcohol has become under significant pressure across the board in the US, but particularly beer. Beer was already losing share to spirits over the last really 5-10 years, but that has even accelerated further. Some of it, as I mentioned before, is the younger consumer trends that are really shifting away from alcohol and particularly from beer, but also GLP-1 drugs, right? Like those people that are taking those drugs, they're clearly seeing a significant reduction in consumption behaviors.
That's interesting. I know this is not scientific, but I was putting out my recycling this week, my bottles and stuff, and I noticed we're not putting out many booze bottles. I think everybody's drinking a bit less.
Yeah, no, it's definitely a trend you're seeing in per capita consumption of alcoholic beverages that's clearly coming down since COVID. There was a peak in the early phase of COVID when everyone stayed home, and clearly there were more drinking occasionally even during the week. But clearly after 2021 and 2022, you really started to see a deceleration. And the interesting thing is that if you look at the per capita consumption, per capita spending among Gen Z consumers, is significantly less than prior generations and significantly less than millennials and boomers. So that's, to me, is more of a secular trend in the alcohol space.
Among the soft drink companies, though, you do have buys, I believe, on Coke, Pepsi, and Keurig Dr. Pepper.
Correct. Like the soft drink companies have performed a lot better in terms of fundamental results and even in the stock performance. You're seeing, look, clearly a significant shift in consumption towards non-alcoholic beverages. The carbonated soft drink companies like Coke and Pepsi and KDP have clearly been able to respond better to the change in consumer behaviors, right? Like a couple of years ago, there was this whole shift to non-sugary option, but they were able to adapt their products. Like the zero sugar offerings are really doing very well for Coke Zero Sugar, for Pepsi Zero Sugar, and the same for Dr. Pepper. And the important thing is the pricing environment is very rational in carbonated soft drinks. So these are companies that consistently grow 2 to 3% their top line, even though the categories are not necessarily the most on-trend categories, like energy drinks, for example, which is a category that is really expanding significantly in the U.S.
And just finally, on the soft drink front, can you generalize? Is this a business where generic supermarket brands have taken a huge share, or have the likes of Pepsi and Cola been able to fend them off?
Yeah, it's interesting because the private label of their store brands, they haven't really been able to take significant share. They've been averaging around 5% market share in the US. If you look at some European markets where private label is more developed, you are seeing levels of north of 10%. But in the US, Coke, Pepsi, KDP have really been able to maintain their share. I think a lot of it is their innovation, and especially, as I mentioned, the zero sugar options have been very, very successful for all these companies. So actually, they've really been able to maintain their overall market share. You're definitely seeing Coca-Cola doing better than Pepsi, and Dr. Pepper also taking some share in the category. But private label overall has been pretty stable, around 5%.
5%. Filippo, thank you very much indeed.
Absolutely. Thanks for having me.
Filippo Falorni, Director, U.S. Beverages at Citi Research. Up next, for the first time in 17 years, a Canadian Prime Minister is headed for China. More on that story next. The Prime Minister's forthcoming trip to China marks the first visit by a Canadian Prime Minister since 2017. CTV's Annie Bergeron-Oliver filed this report.
After years of tense relations, a change appears to be brewing as Prime Minister Mark Carney gets set to try and address thorny trade issues in Beijing with Chinese President Xi Jinping.
No doubt there are going to be challenges, and the two countries won't see eye to eye on everything, but there are some common and shared interests.
Next week's visit will be the first by a Canadian Prime Minister in nearly a decade, and the first since China arrested and eventually released Canadians Michael Kovrig and Michael Spavor in retaliation for Canada's detention of Huawei's Meng Wanzhou.
I really wonder if we'll get anything more than promises out of the People's Republic of China.
One of the biggest flashpoints that's expected to come up, tariffs. Canada imposed a 100% tariff on Chinese electric vehicles in 2024, a move met by China, who implemented a punishing 100% tariff on canola oil and a 25% tariff on certain pork, fish, and seafood products.
We hope that there'd be tariffs, removed immediately. But as I say, this, history has said that the removal of those tariffs does take some time.
But while this 3-day trip is being viewed as a relationship reset, experts say Canada has to be cautious not to trigger any alarm bells in Washington, with negotiations on the North American trade deal set to begin later this year.
If we are seen to go too far down the path of befriending China, we know who in Washington is going to be irritated by that.
But while trade is expected to loom large, the Prime Minister's office says energy, agriculture, and international security will also be up for discussion.
Okay, here's a look at U.S. futures as we count down to the opening bell. And it looks like stocks could see some selling when the market opens, both Toronto and the S&P 500 slipping yesterday, dropping from record highs. Let's have another look at some of these U.S. defense giants in the pre-market. Lockheed Martin will do as a proxy. Those stocks actually came under pressure at one point yesterday after U.S. President Donald Trump said he wants them to step up investment in actual weapons production. LMT is the a symbol for Lockheed Martin, if we have it. He said he wanted them to step up actual investment in defense production and suggested that they stop buying back stock, ease up on the stock buybacks. But then, of course, he's calling now. He can call for whatever he wants. We don't know what actually will happen. He's calling for $1.5 trillion US in military spending. So we have seen a surge in some of those stocks in the pre-market. And let's have a look at gold here, because gold has been such a winning story for Canadian and investors around the world. And that's interesting. Bloomberg says that we've seen selling in precious metals for a second day because investors are standing by for an annual rebalancing of commodity indexes. And that is going to see futures contracts sold in the next few days. And apparently, silver could be vulnerable. Maybe we can put up a one-year chart for silver. Citigroup thinks that almost $7 billion US of silver futures could be sold to meet this rebalancing requirement. However, lots of investors bullish still on gold, and there still is talk of a $5,000 US gold price in the first half of this year. We have those opening bells next. And there you have it, the opening bell action at the Nasdaq. Sunopta, the provider of natural foods, whatever that means, is ringing the opening bell. Wedbush Securities is doing the honors in New York. And at the TSX, it's CIBC Asset Management opening the market. It's time for the first 50. Trading's just getting underway. Let's check in on the North American benchmarks with markets hovering near record highs. They're down a little bit in early trading, but not too drastic. The TSX slipping about 0.33% to open the games here on this Thursday as we move deeper into 2026. Oh, let's give you a year-to-date scorecard. As of last night, the TSX was up about 1% so far this year, and the S&P 500 was up 1.1%. And both those indexes hit record highs earlier this week. Some stocks of interest here. Lundin Gold has, look, wow, up well over threefold, about basically fourfold in the past year. Lundin Gold says that it has prospects in copper in Ecuador that it says could ultimately, or the area that it's digging in, could ultimately rival Peru and Chile. So they are saying that they found a major copper deposit in that country. That's the word from the CEO, Jamie Beck. Let's have a look at another company here, which is Largo Incorporated. That company is a player in vanadium. The stock is down. The company cautioning investors today that it might be selling stock. And of course, that can tend to weigh on an equity. The company says it's establishing a so-called at-the-market equity offering program under which it might issue shares for gross proceeds of up to $60 million US on the NASDAQ. And let's have a look at TELUS here, because the company's saying it's looking at options to monetize, aka liquidate, some of its holding in TELUS Health, and it's hired advisors to help do that. Right, let's check out some stocks south of the border. We are joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Jeff, thanks very much indeed. Remind us what's going on with these defense stocks, please.
Yeah, the defense stocks, a lot is happening here. Defense stocks are the top performers in the S&P 500 so far this morning, which may be a little bit of a surprise if you went home last night with just the headline that Donald Trump was going to prevent these companies from buying back their own shares in the future, from increasing their dividends, and potentially put a limit as well on executive compensation. But the headline this morning that is driving these stocks higher, and the one that's getting the most attention right now, is that Donald Trump has talked about increasing the U.S. defense spending budget to $1.5 trillion. That is $500 billion more than it previously was, so a massive rise. And what we're seeing this morning is the three top performing stocks in the S&P 500 being Northrop Grumman, L3 Harris, and Lockheed Martin. A number of other defense stocks are also rising on this. But these are very, very big share moves for these companies, which are, traditionally a little bit slower in terms of growth, just because of the the nature of it, how long it takes to build and deliver some of these systems, like the fighter jets, etc.
And Trump sounding a populist note, though, yesterday, saying, hey, cut back on the stock buybacks and invest more heavily in actually building weapons, please. Speed things up.
That's right. So it's been a kind of a little bit of whiplash for investors, because as soon as that headline came out, these stocks all fell. And now you're getting the opposite effect this morning. So kind of difficult for investors to keep pace with what exactly is happening in this sector when things change so quickly.
GM, Ford, and Stellantis got an upgrade.
They got an upgrade at Piper Sandler. They also got price target boosts at Piper Sandler. The firm there is really sounding kind of an upbeat note on the future of the domestic auto industry in the United States, for different reasons for each of these three stocks. But kind of one of the general themes that is supporting all three of them is a little bit of a rollback in EPA and some regulations in the U.S. under the Trump administration. But there are other reasons for the upgrade kind of underneath the hood. And so if we go through the list, GM, Piper Sandler says this company, the earnings power is too difficult to ignore. It's getting an upgrade as a result. Ford is getting an upgrade partly as a result of its decision to stand down on its electric vehicle and European kind of push that it had been going through. Of course, we spoke, I think it was only a few weeks ago, about the great big charge that Ford had to take to write down its business in that electric vehicle segment. And then Stellantis. This is more of a contrarian call, and the firm Piper also said it was maybe a little bit more of a messy call. But it sees its U.S. market share having bottomed now. So I suppose this is a rebound story for Stellantis. But all three of the big U.S. automakers getting an upgrade, getting a lift, and getting a price target boost so far this morning.
Jeff, thanks very much indeed. Jeff Morgan. And now we started off the show with Grant White telling us that clients, the number one topic is still AI. We are going to hear from a portfolio manager after the break who says, yep, there still are signs that companies are making plenty of profits on their investments, or massive investments in AI. We'll talk to Justin Elliott of Caldwell after the break. Those housing markets in Toronto and Vancouver, which were once red hot, are posting all-time sales lows as sellers struggle to find buyers. CTV's Adrian Gabriel filed this report.
These are some wild numbers, aren't they? Wild, wild numbers. Wow.
Wild and worrisome.
Imagine how many more people there are here now than there were 25 years ago. Yeah, these are spectacularly low numbers.
You have to go back to the year 2000 to find Toronto home sales lower than they are right now. In 2021, sales peaked at more than 127,000. Last year, that number plummeted to roughly 62,000, according to the Toronto Regional Real Estate Board. On the receiving end are sellers like Hossein Hodadi.
It's really frustrating.
He bought and moved into the Stouffville home north of Toronto in July of 2022. Following renovations, mortgage rates spiked. He's listed the property to sell twice, once in 2024 and again in 2025. It still hasn't sold.
I'm afraid not to be able to cover my mortgage and my living expenses.
In Vancouver, the number of for-sale listings in 2025 hit a record high, not seen since the mid-90s. But sales are at historic lows. Residential sales in Metro Vancouver bottomed out at 23,800 last year, marking the lowest annual sales total in more than 20 years.
Vancouver is still extremely expensive real estate. It's more expensive than Toronto.
Sellers in both markets are experiencing a peculiar predicament.
Borrowing costs and selling prices have trended lower, and that's across most major market segments. Yet at the same time, sales were off.
Leaving many wondering what, if any, movement 2026 will bring for debt-heavy homeowners desperate to offload their pricey properties.
Some housing insiders expect stagnant sales to continue for at least the next 6 months as uncertainties around the economy and interest rates remain. Adrian Gabriel, CTV News, Toronto.
Okay, let's get back to those AI stocks. There's plenty of noise on the geopolitical front, but our guest says you should keep focus on the AI trade, and he's broadly bullish on the equity markets this year. We're joined by Justin Elliott, portfolio manager at Caldwell Investment Management. Justin, thanks very much indeed for joining us.
Thanks for having me on.
You see enough evidence of growth in the demand for AI in the AI market to stay broadly bullish. For example, you say that companies using these chips say one of the big constraints is they still can't get enough of them.
Yeah, that's correct. Obviously, the sort of AI bubble narrative is front and center for a lot of investors. And there's a lot of concern regarding, the rising CapEx intensity and the return on that CapEx spend. But we do align with the AI bull narrative, and our optimism for that sort of continued spending and acceleration and growth in the industry is backed by a few points. So the first would be, that existential risk still remains. And the most recent demonstration of that was ChatGPT's Code Red when Google's Gemini 3 came out. And so, spending needs to be maintained to, hold your leadership position at the front of the frontier, basically. The second would be, bottlenecks to the point that you brought up. And that's on both the LLM provider side and the hyperscaler side. So for LLM providers, some of the leaders, such as ChatGPT, have spoken to, throttling product releases and not being able to release what they like just due to the lack of GPUs. So, Sam Altman has said that they could potentially double revenue if they had access to more GPUs. On the hyperscaler side, we've heard things within Google, for example, of internal departments competing for access to GPUs. Obviously, the researchers building the models want more access, and the product teams building the product, sales teams want that to generate revenue. The last thing would be that we see more capable models should equal more useful agents, and that will drive up enterprise and consumer use cases. So 3 really key points why we're still kind of bullish on this trade heading into the new year.
Right on topic, Alphabet is one of your stock picks here, a massive buyer of these GPU chips, graphical processing unit chips that have the power to handle all these AI computations. So Google's had such a run, but you see more upside.
Yeah, Google is basically the only AI player with a full vertical stack. So they've got, the frontier model that they own and that they develop, and they've got their own kind of custom hardware at scale. And they've got some of the best distribution as well. That's really a huge advantage across all of Google's products. And so we see basically them leveraging that advantage to drive, lower costs for AI. And that's going to entice customers to switch from other cloud providers over to Google to improve their own return on invested capital for using AI. And we think that helps or should help generate, accelerating growth in Google's cloud division into the new year. And, they'll take share most likely from the others, Amazon and Microsoft. The second is just as that business scales up, obviously the margins have improved. And so as Google keeps releasing new generations of models, new generations of chips that, try to boost that efficiency, that should translate into continued margin improvement. And the last would be just them integrating these AI benefits really into their core search business. So on Google Search, AI can lead to people staying on the page longer and converting at higher rates as well. So that allows them to, charge more for the ads because they're more effective, and that should drive continued growth in their search business.
You have another tech adjacent idea here, Huron Consulting, HURN on NASDAQ. Just remind us what they do, please.
Yeah, they're a consultant based in the U.S. They're primarily focused on education and healthcare markets. And they're basically exposed to a lot of U.S. government customers, government adjacent customers. One big sort of secular tailwind for them is obviously the changing regulatory environment in the United States. And the passage of the, big, beautiful bill last year put a lot of pressure on both healthcare markets and education markets. So hospitals, for example, have a fresh sense of urgency to really improve their operations, to modernize and to try and use AI, for example, to really improve their revenues, improve their cost base. And it's a similar dynamic on the education front. And so we think there's, really strong demand for their services. And given the urgency, you've actually seen an increase in the size of engagements over the last couple of quarters. And we think that's really promising for the future outlook as that becomes more pressing and companies really rush to optimize their operations.
And finally, Interdigital, IDCC, and this is a big holder of intellectual property and technology?
Yes, that's correct. So they are a developer of patents that are used in a lot of the standard technologies that we sort of take for granted every day. So 4G, 5G, what will be 6G on phones, Wi-Fi settings, even video codecs. So that helps basically compress file sizes for streaming. What we see as really a major upcoming catalyst is litigation with Disney over streaming services. And basically, all the streamers have been using their patents without properly compensating IDCC. Courts have been more recently ruling in IDCC's favor, and we think that helps push the negotiations along and should set up a deal for Disney and IDCC, which will be precedent for all other streamers to do a deal with IDCC. And, net benefit of that is basically just driving higher sort of recurring revenue for the company. And it's at very high margins as well, because there's very low cost to, add another licensing deal basically to your base. And so, we see continued margin expansion from that growth. And a lot of that is very durable and stable growth. So we like the company. It's relatively underfollowed, and it's, got a great outlook in our opinion.
Justin, thanks very much indeed.
Thanks for having me on.
Justin Elliott, Portfolio Manager at Coldwell Investment Management. Up next, top Canadian economists are calling on Ottawa to implement tax reforms to boost competitiveness. Economists at Canada's biggest banks are calling on Prime Minister Mark Carney to reform the tax system. They argue that investments announced in the latest budget won't meaningfully move the needle on Canadian competitiveness. For more, we are joined by Bloomberg's Toronto Bureau Chief, Melissa Shin. Thanks very much indeed for joining us, Melissa. You've been listening to economists with their projections for the economy. What was the general mood and tone?
Yes, there was sort of a sense that last year the worst case scenario could happen, and it didn't. The economists sort of had this sense of cautious optimism, feeling that it wasn't as bad as it could have been. That being said, there was a joking point made by Chief Economist Stéphane Marion from National Bank of Canada, saying that if the Blue Jays hadn't made the playoffs, we would be in a recession. I haven't checked those numbers myself, but the point being made that growth is sort of anemic at the moment. So as a result, there is a need for some urgency, some reform. They did acknowledge that there were a lot of investments pointed to in the budget in November, but that, as you mentioned, they won't necessarily move the needle meaningfully, and that tax reform instead is what is needed.
Right. And this was a gathering, I think it's an annual gathering of economists at the Economic Club of Canada. Talk to us about these tax changes that they want.
Yeah, so I mean, the setting the stage a little bit, the reason is that, for example, small businesses have preferential tax treatment up until $500,000 of revenue, which sounds like a lot, but it actually isn't really that much. And after that point, the tax rate that they pay incrementally goes up. And so there actually is sort of according to some of the economists, a bunching of firms that kind of try to keep their revenue around that threshold. Mm-hmm. And so, that amount was put into place more than a decade ago, and Beata Caranci from TD recommended at minimum indexing that figure, saying that would be somewhere closer to $700,000 now. She also observed that, for example, in Ontario, the two top tax brackets are not indexed, and that as a result, people who are making more money as a result simply of inflation are kind of moving into higher tax brackets, paying more tax. So, in general, this kind of discourages people and businesses from making more money in a more general sense, and also regulations and the regulatory burden can do that as well. So kind of looking at this and seeing what can be done to kind of change these incentives.
Melissa, thank you very much indeed. That's Bloomberg's Toronto Bureau Chief, Melissa Shin. We have lots more coming up on The Open. And we're going to tell you about this new data that indicates that Canada is actually diversifying in terms of its exports, reducing the share sent to the United States. Been pressure on Canada to reduce its export dependency on the United States. And it looks like, at the end of last year anyway, we were making some progress. Let's get more from BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, some progress, Andy. For the month of October, these numbers coming out today from Stats Canada, exports to the U.S. were down 4.1%. So of everything Canada exported in total, 67% went to the U.S. So obviously still our largest trading partner. But those numbers are coming down. That's the lowest level since this current way of evaluating all these numbers was established in 1997, excluding the pandemic. So as you mentioned, this is something that the Prime Minister Mark Carney has pledged. He said he really wants to diversify our trade away from the U.S., be less reliant on the U.S. when it comes to trade. And these early numbers, it would appear that we're starting to head that way. Again, this is just 1 month in October, but we're seeing the numbers when it comes to exporting to other countries going up compared to the U.S. So exports to non-U.S. countries jumped more than 15%, and most of that is due to shipments of gold and precious metals to Britain. That was the biggest exporter, the biggest drive for seeing these numbers. And then secondly, oil to China.
What about trade exports overall, Lindsay? What can you tell us there?
Yeah, so Ottawa recorded a trade deficit of $583 million Canadian. So that's actually much smaller than what most economists were expecting. They were expecting somewhere about $1.5 billion. But we're still seeing, imports, more imports than we are exporting goods, at least in the month of October. Total exports rose by 2.1%. Exports of precious metals went up 47% in the month of October, and energy exports fell 8%. And then, of course, you're seeing these other sectors because obviously we still have tariffs hitting some sectors that are not protected by the free trade agreement. So you're looking at the auto industry, lumber, steel, and aluminum. Many less exports. The numbers are way down when you're looking at exports of those sectors going over the border to the U.S., but not as rosy as a picture when you look at the yearly numbers. From the start of 2025 till October, exports were up just 0.8%. So economists saying it looks good. There's reason for cautious optimism, but at this point, maybe we're not out of the woods yet. But most are saying when it comes to the impact of tariffs on Canada, we've seen the worst of it is in the rear view mirror. That's at least what analysts from TD Bank are saying this morning.
I suppose there'll be lots of headline risk as we move into this renegotiation of the broad free trade agreement with the States.
Yeah, that's going to be really interesting to watch. A lot is hinging on those agreements, and some people, saying that it could take a while for those agreements to come through in those negotiations.
Lindsay, thanks very much indeed. Lindsay Biscaya. Up next, defense stocks, as a reminder, jumping after U.S. President Donald Trump called for a defense budget of $1.5 trillion. More on that next. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Canadian exports to non-US markets saw an increase in October. Data from StatsCan indicates that total exports rose 2.1%, driven by gold shipments, especially to Britain. Meanwhile, the value of Canadian exports to the US fell, or the proportion fell to just over 67%, the lowest level on record outside the pandemic. Imports were higher as the country brought in record shipments of computers and computer parts. Smartphones and industrial machinery and equipment also drove the increase. Shares in TELUS up about 2% today. The telecom giant has hired TD and Jefferies as advisors to help in a review of its TELUS Health unit. The company says the move will help develop monetization strategies with a focus on finding a strategic partner. Shares in Lundin Gold slipping today. The company, well, of course, they've soared over the past year, well over 200%. The company says it has found a potential world-class copper deposit in southeast Ecuador. The CEO says the area has the ability to rival other copper hotspots, including Peru and Chile. And there is a look at the TSX Composite under a little bit of pressure today. One stock, though, that is doing fairly well is MDA Space. Now, the company has outlined a deal, it's clouded in the usual defense jargon, with the U.S. Missile Defense Agency. And the Beacon says that essentially this is an indefinite delivery, indefinite quantity contract from the U.S. Missile Defense Agency. And it qualifies MDA to compete for task orders. SHIELD is a $151 billion procurement vehicle for President Trump's Golden Dome initiative. And MDA looks like it could be in line for a piece of that. Let's have a quick look at the U.S. markets, and you can see the S&P and the NASDAQ seeing some selling right now. Let's check out oil, because oil, which has had such a miserable year, down 23% in the past 12 months, showing some signs of life right now, but still shy of $57 US. Let's have a look at gold. Bloomberg says a bunch of index rebalancing in the commodity market is influencing potential sales of contracts, and that is affecting trading in precious metals. Gold down about 0.5%. And let's have a look at the Canadian dollar. And it is generally holding its own against the US currency at just over 72 cents US. Shares in defense stocks higher today. Look at that. RTX, Northrop, Lockheed Martin, all up. The latter two almost 10%. U.S. President Donald Trump is calling for a military budget of $1.5 trillion U.S. in 2027. Reuters says the budget approved for this year is only about 900 billion. So that would be an enormous increase. We're joined by David Sequeira, U.S. Chief Market Strategist at Morningstar. David, great to see you. Thanks very much. I mean,
good morning.
I mean, this could be just a number the president has plucked out of the air. I mean, that would be an enormous increase.
Exactly. You know, love him or hate him, you got to say there's just never a dull day when you've got President Trump, in office. But I think we need to put, the defense stocks in a little bit of context, this morning. So first of all, they actually sold off, several percent yesterday. That was on the back of President Trump making some commentary that he wanted to see those companies, halt their stock buybacks, reduce their dividends, really reduce executive pay. He wanted the companies to spend a lot more of their money on, growth capital expenditures. From our perspective, I think that's just a lot of rhetoric. I'm not sure necessarily how he could really implement that. So there was no change to our long-term intrinsic valuations. And of course, today we've got all of these stocks now surging based on the talk of that increased, defense spending. So I'd just say with President Trump, you also just have to take this with, not just a grain of salt, but a mountain of salt. Mm-hmm. He always starts off with, the most, extreme position, that he can take. And then from there, he seems to always negotiate down. But either way, certainly provides a lot of positive market sentiment and definitely a catalyst to increase valuations today. I just note that here at Morningstar, we've been very constructive on defense stocks, for quite a while.
Lockheed and Northrop are two stocks that you have a buy on.
Exactly. So on the Morning Filter, which is my weekly podcast, first one that we had highlighted was actually over a year and a half ago was Huntington Ingalls. It's a manufacturer for nuclear submarines. That stock has done very well since then. That's another one that I still think investors should take a look at today. It's often overlooked by the marketplace. Doesn't have the same name brand as a Lockheed Martin or a Northrop. Mm-hmm. With the movements today, it's taking those stocks up pretty close to what our long-term fair value, intrinsic valuations are on both of those. I'd say with Lockheed, I would expect the U.S. government probably start ramping up, the time frame for deliveries of F-35. So that's going to be, another good tailwind for that stock for at least a couple years, yet to come. And then with Northrop, similarly, I would expect that we're looking for them to take deliveries of B-21 bombers. Originally, we were looking for them to take delivery of 100 of those between 2026 and 2028. So I'd look for a pickup there as well. And for all the manufacturers, especially someone like Northrop that has a lot of the business in space defense systems, I expect a lot of money to go there. And then another one to throw at you, I just got off the phone with our European strategist. The one that he would recommend, and I'm probably going to mispronounce the name here, it's Rheinmetall or Rheinmetall.
Yeah. Right.
Yeah, it's a 4-star rated stock. Last I saw, it's trading at an 18% discount to fair value. It's a company we rate with long-term, competitive advantages, a wide economic moat. They're the largest defense contractor in Europe. And our base case right now also calls for Germany's defense spending to reach 3.5% of GDP by 2029. So it's not just the U.S., increasing, spending on defense here as well. I mean, we're seeing it globally, seeing it in Europe. We had noted on the morning filter, last year with our Trump trade stock picks, in the spring of last year, a lot of companies in the Middle East, like Saudi Arabia, had negotiated a couple of deals there. So just, a huge increase in spending, globally, not just the U.S.
That's interesting with that Huntington Ingalls, apparently America's biggest military shipbuilder.
Exactly. And in fact, they also just got a new contract from the Department of Defense to start building some new frigates. We included that in our fair value, relatively recently as well. But I think that also just shows, the positive sentiment that the DoD has, for that company. So I expect to see more contract wins coming from them as well.
I have to ask you, you said it's the Morning Psalter. A psalter would traditionally be a book of poems, of poems, yeah. I don't now I'm losing it, but Psalter, is that what it is?
No, I think it's just me. I'm not being very clear with my enunciation. So my weekly podcast is called The Morning Filter. Oh, so Filter. So it's like, join me in the morning, have a cup of coffee with me. It's Monday mornings. We always talk about what's coming up on the week ahead. I'll highlight, some of the Morningstar research that was published the past week that we think investors shouldn't miss. And then I always wrap things up with a couple of, picks, pans, swap ideas, but, something that's action oriented for investors.
Sorry, yeah. Traditionally, the Psalter would be a volume containing the Book of Palms. Okay, let's move on from that one. We have another couple of stocks. Obviously, NVIDIA is always on our radar. Just give us your quick thought on NVIDIA, please.
We still think NVIDIA is undervalued today, but I think at this point you really need to see what the AI CapEx guidance is going to be, coming out later this month from the hyperscalers. At this point, the market is, we have very high valuations on AI stocks, overall. A lot of them, like in NVIDIA, still are undervalued today, but I think we're going to need some positive market sentiment really to start the next leg up, in some of these stocks. The market's already pricing in increases by the hyperscalers in their 2026 AI CapEx spending. So at this point, we're waiting to see what those numbers come out end of January, beginning of February. And, based on that, we'll see what the market sentiment is. We suspect those numbers will be pretty positive. So we're still looking, for further upside ahead. Having said that, it's one of the indicators that I'm looking at that I think we're going to see even more volatility in the U.S. markets this year than we saw last year. Last year we had the big bout of volatility, starting with the DeepSeek when that hit the headlines in January. We had, the Trump, Liberation Day, tariffs, which pushed the market down, even further. But then by April 7th, the market had fallen enough. That was the point we moved, from a market weight to an overweight recommendation in equity markets. So again, I suspect between all of the risks that are out there that we're looking at today, I think there's a lot more volatility yet to come in 2026.
Thank you very much, David. Always fun talking to you, and have a great 2026. Yeah, I just had a brain glitch there. Of course, it's Psalms. That's how it's pronounced, the religious chants. David Sekera joined us there, U.S. Chief Market Strategist at Morningstar. Coming up, it has been a sluggish few years for Canadian real estate, but our guest says we may be seeing light at the end of the tunnel. It has been a sluggish few years for Canadian real estate, but our guest says we may be seeing some light at the end of the tunnel. Okay, let's get a broad look at real estate. So many factors here. We're joined by Brian Rosen, President and CEO of Colliers Canada. It's great to see you, and thank you very much indeed for joining us.
Thanks for having me.
Start off with office, because it's obviously top of mind right now. Ontario government, for example, saying to all its employees, we want you back in the office.
Yeah, its office has been really the pickup that we saw in the second half of last year. It was the best quarter in Q4 for absorption in the last almost 8 or 9 quarters, where the banks, the big financial services companies, the government, they all started sending their people back to the office. And it's a real flight to quality. And we've heard that expression over and over again the last year or two. And it's real. And it showed a drop in vacancy of almost 3% in the downtown core. And that really just showed a lot of, again, the big banks and the government starting to take more space. And that's going to have a trickle-down effect on not just the top end of the offices, but the next class of office too. So we're going to start to see vacancy come down over time as more and more workers come back to office, the economy starts picking up, et cetera.
It is interesting. I mean, if I'm running a bank, I guess it would be tempting to just get rid of my office blocks and have everyone work from home. Would cut out enormous expenses, but it looks like they're not going that route.
Or they did, and now they're taking more space and getting it back. And so it's really interesting. And a lot of us in the beginning were saying that there was going to be a reversion to the mean at some point, and there has been. And I think that is that's what's happening, and it's going to continue to happen over time, particularly as there's no new office being built. So there was a huge amount that started just before COVID, which was awful timing, and it was coming online the last couple of years. But now nothing's going up, and so you're just going to continue to see the vacancy decline over time.
Talk to us about real estate. I mean, condos, we know there's been a meltdown there, especially in Toronto, for example. People don't want the tiny units.
Yeah, there's a mix issue is a problem. There's the slowdown in immigration and people coming in. We went from a massive housing crisis in one direction where we had no housing to now we have the tanking of the condo market that happened. So it's a complicated situation right now. So rentals are still decent, but we're not seeing much growth in the rent on that side. There still are pockets of that. And the absorption on the condos is going to take a couple of years for that to come back. But there are signs that we're nearing a bottom. However, there still expects to be distress in 2026.
One interesting thing we've heard is, well, this again, apologies to viewers, I think this is very much in the Toronto market. Condos were sold without parking spaces, and now they've proved to be difficult to sell. People want a parking space in many cases.
Yeah, that could be it. Also, what happened was we got a mix of a lot of one bedrooms and studios that don't necessarily appeal to the families that are looking for it. So you got the mix issue that also created a problem. You had all the non-permanent resident decline that we saw in immigration, and that created a lack of demand. So it's got to cycle through as some of those condo prices that were being rented out start to come down, and we start to get more absorption into that market again. But right now, there's been a real pivot towards rental versus the condo.
And are we seeing a lot of rental construction, new supply?
There's not a ton coming out there because development costs are still high.
Yeah.
So we have not seen a big fall. Obviously, interest rates have made lending more affordable, which has been a positive, but it still takes a long time to develop with all the approvals and permits and other thing that goes through. And the cost to develop construction, land, et cetera, is still very high. It's not as competitive. Now, there's a lot of proposals on the table with government and other things to make it better, but it has yet to really move the needle.
I mean, the municipalities, I guess, can say, well, look, we just got to balance our budget somehow, hence these big development charges.
Yeah, but some are going the other direction and saying if nothing's developing, if you're taxing and you get zero times zero is zero, last I checked, right? So there are some municipalities that are putting in waiving development charges or putting in different promotions for that. And we'll see if that ends up trickling through. And it's a good start, but we need to definitely see more of that before it picks up again.
I sometimes wonder, do we have too much democracy? I mean, we consult residents. Are you okay with this? I mean, if a building meets code, why not just build a darn thing?
Well, I've lived in the U.S., I've lived in Houston, I've lived in places that have a much faster track for development, and that is absolutely a reality. There are benefits with having consultation, of course, but I think there's a lot of people in real estate who believe there's too much of that, too much NIMBYism in Canada.
What about the warehouses, the big e-commerce warehouses? They were such a hot category during COVID because we were shopping from home. Have we seen the same kind of growth there?
Well, digital and online buying has definitely continued. What we saw in 2025 was definitely a slowdown in some of the industrial sector. It's still a very healthy sector in terms of the amount of product and the amount of demand. So it's not in a bad shape. It just slowed down from the tremendous rent growth pace that it was on and the amount of building. So what we saw was more of the smaller small-based warehouses and logistics were moving more frequently. The larger stuff was a little bit harder because of the tariffs and some of the uncertainty. But we've kind of gotten to a point where constant uncertainty has become certainty. And people are now just pricing that in, and they're going about and running their businesses, and that means they're going to take on more space.
Calgary, to some extent, has been an exception when it comes to lots of real estate trends. Can you just touch on that briefly?
Yeah, there's a lot of positive. It's a cyclical market. Obviously, it's very commodity-driven, but it's well-placed for an industrial growth. It's pretty close to Vancouver. It's more affordable to build there. Multifamily, it's had more influx of immigration, which has positive trends. It has a lower rent base, cost to rent. So there's more opportunity for people to live there and for investors to make value. So it definitely has been an attractive market on multiple asset classes.
Brian, thanks very much indeed. Brian Rosen, President, U.S. Northeast Region Brokerage and Chief Executive Officer at Colliers Canada. Coming up, today's ETF report. Yep, we're putting the spotlight on defense stocks. Well, we know that defense stocks have been gyrating over the past couple of days. U.S. President Donald Trump coming out with one announcement or one threat that pushed them down yesterday. He said, I want you to curb these stock buybacks and invest more in actually building weapons and getting stuff into use faster. But then he said, and I believe this was just on a social media post, I want a defense budget of $1.5 trillion US next year. Reuters says the current budget is only about $900 billion. There are a couple of ETFs you can buy, TSX listed, that play defense. One is, it's from Global X, and it's a global player. It's called the Global X Defense Tech Index ETF, SHLD. And there is a look. You can see it's had a pretty good run over the past year. Unfortunately, of course, countries around the world feel obliged to spend more on defense. With this one, you're getting a weighting of 63% roughly in the United States. Korea is number 2 at 11%. Germany at about 8%, and the UK at about 6%. Where's Canada, I wonder? Why don't we have big domestic defense firms that show up on the global scale? Palantir, as of late November, so this is going back a while ago, was the biggest holding in Global X Defense. Palantir, the software company, then RTX, then General Dynamics, the maker of the Abrams tank, then Lockheed Martin, and then I think it's Rheinmetall, they would say, the German arms maker, and then BAE Systems of Britain. But it makes me wonder, why doesn't Canada have a global defense company? I know we got Bombardier, which has a bit of a defense business, but we just seem to be an appendage to the US when it comes to this stuff. There's another one then that is more narrowly focused on the US aerospace and defense industry. That one is the iShares U.S. Aerospace and Defense Index ETF, and it trades as XAD on the TSX. The GE Aerospace shows up actually as the biggest holding there. That's interesting. So they would have a big civilian business. Then RTX, that is about 16% of that ETF. Then Boeing. So it's, in some ways it's, well, it is, I guess the name says that. It's aerospace as well as just defense. And you can see that one has climbed pretty nicely over the past year. Other big holdings in there, Howmet Aerospace and Lockheed Martin, of course, and Northrop Grumman and General Dynamics. And so with this rally in defense stocks over the past year, there are 2 options if you want to play it with ETFs. Right, we've got lots more ahead. We're going to update you on the latest headlines and markets, and we'll look at how the U.S. unveiling its strategy on Venezuelan oil is spurring a rush for access to crude. Canadian exports to non-US countries saw an increase in October. Data from StatsCan indicates that total exports rose 2.1%, driven by gold shipments, especially to the UK. Meanwhile, the value of Canada's exports, or the proportion of Canada's exports to the US, fell to just over 67%, the lowest level on record outside the pandemic. Imports were higher as the country brought in record shipments of computers and computer parts. Smartphones and industrial machinery and equipment also drove the increase. MDA Space is one of the best performers in Toronto today. The satellite systems firm is in line for contracts from the U.S. Missile Defense Agency for its SHIELD program. This program works on ballistic missile defense systems for the U.S. and its allies. MDA says the deal is indefinite and positions it to bid on future tasks and services to support that U.S. defense initiative. And there is a look at the TSX Composite, now higher. I don't think it's got back to the record high that we saw earlier this week, but give me 1 sec to check that. 32,160. No, on Tuesday we closed at just over 32,400. And the S&P also turning higher. And it, though not back to Tuesday's record high either. Oh, you can see now it's flat. Yeah, the U.S. market closed at a record 6,944 on Tuesday of this week. Let's have another quick look at oil, because oil has been roiled over the past week by the U.S. president capturing or kidnapping or seizing the leader, Maduro, of Venezuela. And the Americans saying yesterday that Trump, according to the Energy Secretary, Chris Wright, that the Trump administration plans to control future sales of Venezuelan oil. But of course, the U.S. content so far to leave the Venezuelan, the repressive Venezuelan regime in place. The country is being run by a loyal deputy of Maduro, the kidnapped leader. Well, let's get more on the U.S. taking control of Venezuelan crude. The speculation here is that it could ultimately reinvigorate flows of Venezuelan heavy oil to American refineries. Let's get more from Bloomberg oil products reporter Nathan Risser in Houston. Thanks very much indeed for joining us, Nathan. Just give us a bit of history, would you? Traditionally, Venezuela was a pretty big supplier to the U.S., and then that fell off partly because they neglected their oil industry.
Yeah, sure. Thanks for having me. So, yeah, in the late 1990s, early 2000s, the U.S. was importing over 1 million barrels a day of Venezuelan crude. This was going to refineries across the country, but especially down in the Gulf Coast, Texas and Louisiana. You know, you had waves of sanctions, you had growing domestic production, and then those imports slowed to a trickle. Last year, it was somewhere near 200,000 barrels a day. But with all the news this week and Trump's statements, especially late Tuesday, about millions of barrels of Venezuelan oil coming to the market, U.S. refiners are poised, and they seem to be welcoming those extra barrels as a great benefit to their margins and their bottom line.
Because there's a whole bunch of Venezuelan oil sitting in storage that apparently could come to the U.S. In fairly short order.
Yeah, that's the oil that could immediately come to the U.S. refiners. Now, the caveat here is that the kind of any boom in production or growth in production could be a years long effort. But the share price rises that we saw this week, especially for the U.S. refiner Valero, which reached an all-time high earlier in the week, that was largely on Trump's statements that some 50 million barrels of oil could be made immediately available.
We in Canada, of course, have some concerns because we're a rival supplier of heavy oil. Is there any indication as to how could we get some of our heavy oil sales to the Americans displaced?
Yeah, that is one possibility. Of course, these are referred to by refiners as advantage crude grades. They're heavier, they're a little bit cheaper, they can be harder to process. Canadian and Venezuelan are both heavy oils. The Phillips 66 CEO Mark Leisure said this at a Goldman Sachs conference earlier this week, that if more Venezuela comes to their refineries on the Gulf Coast, they could see a kind of a cheapening, a wider discount for those Canadian grades that head into the Midwest. But one potential boost for Canadian oil could be that if Venezuelan oil starts going to the US, that might displace that flow to China. They might want to start taking more Canadian oil off what's known as the Trans Mountain Pipeline that exports crude overseas from the west coast of Canada. So there's a few factors here that could balance out.
And then there could be another bonus here for U.S. refiners, because they might send more of their naphtha product down to the U.S., and that gets blended with the heavy stuff down there. So it's good news potentially for U.S. refineries?
Yeah, the benefit could be twofold. They might start being able to access imports of that cheaper Venezuelan crude, but they might in return be exporting what's known as naphtha, which they use as a diluent, a product that dilutes the heavy Venezuelan crude oil.
Thank you very much indeed. I really appreciate it.
Thanks for having me.
Nathan Risser of Bloomberg. Okay, up next, we've got hot picks in financials. Don't go away. You're watching The Open. Time for Hot Picks. Our guest has Capital One Financial as his top idea. He says its acquisition of Discover Financial Services will continue to add to earnings power. Let's get more from Moshe Orenbach, analyst at TD Cowen. Thanks very much indeed for joining us. Really appreciate it. Start off with Capital One. We know them as a big provider of cards. Why does this stock tick off the boxes for you?
Sure. And Andrew, thanks for having me. So I think that, Capital One has always been known as a big credit card player. I think that for a number of years, given its acquisition of a few banks, roughly a decade ago, and some of the investments it made in technology, its returns had suffered a little bit. And so its returns were a little below where other players are. And I think post this acquisition, in addition to some of the offensive positives, like being able to grow faster using the Discover brand, but more importantly, even than that, is the fact that they can kind of rationalize their capital base and get their returns from a mid-teens up to 20% or better. And that's the single biggest thing that drives valuation in financial services companies is high returns. And I think that's the case. They announced a $16 billion buyback. They've actually got $17 billion of excess capital, so that's not the end of the story. Mm-hmm. They'll have lots of opportunity to do that, but that's going to be a big driver. And as 26 kind of rolls along, they'll be able to use the Discover brand more aggressively to grow the top line.
And just we're tight for time, and I'm sorry, but what is their business model? So they issue Visa cards, do they?
So Capital One is the largest issuer, at least measured by balances, of Visa and MasterCards in the United States. They also are one of the larger auto lenders, and they have a banking business as well. So their business model spans all those. They're best known for the cards because they're a big advertiser on television.
Right. Synchrony Financial. Can you remind us what they do, please, and tell us what draws you to this stock?
Sure. So Synchrony is a kind of private label and kind of white label issuer where they go in for partners, some of their big partners like Walmart or PayPal and Amazon, and lend to their customers. And that's what they do. They have about $100 billion. They're not quite as large, but they're the largest kind of in that space. What draws us to them is that because of some pricing changes that they've done and the fact that they just restarted their contract with Walmart, their growth should accelerate in 2026. We've got 7% revenue growth, and that's what's attractive there, and it's relatively inexpensive.
And finally, I do I do notice when you're shopping online now, you often get an offer, hey, pay in installments for this thing. I see a lot of ads actually for Klarna, but Affirm is in that similar business, buy now, pay later.
Yes. Yes, it is. And Affirm has got 30% growth in both volume and revenues. It's the fastest growing of the companies that we cover. And I think what they have going for them, in addition to that very strong current position, is they basically have issued nearly 3 million Visa cards so that their customers, and that number is growing, so their customers will not only be able to shop online using Affirm, but in store as well. And that's kind of the next leg of growth for that company. Not one that you'd buy, not inexpensive, but it is a spectacular kind of growth opportunity.
What is the basic buy now, pay later model? They make money off the interest, but is it like a credit card? If you don't pay on time, then you face a very high borrowing cost?
Right. So Affirm is actually very, very adamant about that. They are fixed rate, and you can never get charged more than that. And it's only on the amount that you borrow, and it's paid down over a specific number of months. So it does ensure that the borrower can't get into what they view as a cycle of debt that you could apply kind of to the credit card model.
Oh, that's interesting. So it doesn't balloon out as can happen with credit cards. You end up with an interest rate well over 20%.
Yeah, I mean, they could have an interest rate over 20%, but it's only on the amount that you're borrowing, and it does amortize down as you pay it off over, a set number of months.
Right. Fascinating. But obviously, yeah, I've really noticed that online shopping sites now are pushing that buy now, pay later model.
Yes. Right. That is correct. There's a lot of that going on. And like I said, I mean, e-commerce is large and growing, but in-store commerce is significantly larger. So as they can get that number from, there was 2.8 million of those cards issued at September 30th, get that number higher and, further penetration into in-store commerce, I think there's a next leg of growth as well.
Moshe, thank you very much indeed. Really appreciate it. Moshe Orenbuch is an analyst at TD Cowen. Canada is looking to build non-US trade relations to diversify. And the Prime Minister is headed for China next week. What does this mean for the two countries' relationship? We'll have more on that next. Prime Minister headed for China next week. First visit to the nation by a Canadian Prime Minister since 2017. CTV's Annie Bergeron-Oliver filed this report.
After years of tense relations, a change appears to be brewing as Prime Minister Mark Carney gets set to try and address thorny trade issues in Beijing with Chinese President Xi Jinping.
No doubt there are going to be challenges, and that the two countries won't see eye to eye on everything, but there are some common and shared interests.
Next week's visit will be the first by a Canadian Prime Minister in nearly a decade, and the first since China arrested and eventually released Canadians Michael Kovrig and Michael Spavor in retaliation for Canada's detention of Huawei's Meng Wanzhou.
I really wonder if they'll get anything more than promises out of the People's Republic of China.
One of the biggest flashpoints that's expected to come up, tariffs. Canada imposed a 100% tariff on Chinese electric vehicles in 2024, a move met by China, who implemented a punishing 100% tariff on canola oil and a 25% tariff on certain pork, fish, and seafood products.
We hope that there'd be tariffs, removed immediately. But as I say, this, history has said that the removal of those tariffs does take some time.
But while this three-day trip is being viewed as a relationship reset, experts say Canada has to be cautious not to trigger any alarm bells in Washington, with negotiations on the North American trade deal set to begin later this year.
If we are seen to go too far down the path of befriending China, we know who in Washington is going to be irritated by that.
But while trade is expected to loom large, the Prime Minister's office says energy, agriculture, and international security will also be up for discussion.
Okay, Annie there had a clip from Peter MacKay, former defense minister and foreign minister, expressing wariness over U.S. reaction if Canada moves too close to China. So, U.S. president again blasting NATO. The White House says the president is, quote, actively discussing how to acquire Greenland with military force on the table. End quote. So we got more from Peter MacKay. Let's have a listen.
How seriously do I think the possibility of the United States attacking Denmark is? Not very. I think, number one, there are much bigger priorities for him, although he has clearly coveted the critical minerals and the strategic advantage of having Greenland. But it's another NATO country. They're part of Denmark. There has been a lot of musing and a lot of bombast and a lot of braggadocious nature within this president. But a military attack is one thing. Trying to work out some sort of an association with them, keeping in mind that they have a military base in Thule, Greenland. They now call it Piftik, I believe. But there is a historic relationship there. Concerns about the vulnerability of the Arctic, which Canada shares. The fact that the U.S. has other similar type of relationships with countries where they provide security, that's a more realistic pursuit than any kind of an invasion, in my opinion.
Okay, we often hear Donald Trump sort of go big with the threats only to ratchet it down to come to some sort of agreement, and you're thinking that could be what happens here, some sort of agreement with Denmark and Greenland to get access to what that island offers?
Exactly. And using leverage like this by starting big, as you put it, and then working their way back. But look, the situation in the Arctic is serious. There is concern about Russia. There is concern about China, others navigating in or close to Canadian waters. And so this is something we need to keep an eye on. But, you know, we saw the Prime Minister in Europe telling Denmark, the president there, that, you know, we stand with Denmark and our NATO allies. I think there's plans now to open an embassy there, visits from Canadians. We have to be a little bit careful walking that line, not poking the bear, so to speak. But I really don't think that this is going to be a pursuit, a realistic pursuit by the U.S. administration. And I think people like Marco Rubio are going to try to walk this back at some point in the near future.
You mentioned Arctic security. We know that Canada is trying to beef up the defense of the Arctic as part of its plans to put more money into sort of security itself. So is that threat at this point escalated to a level that perhaps Greenland needs a bigger military presence from the U.S., Canada, or others?
Well, I think I would focus more on what Canada has to do. And we've been in talks now for some time about improving the security around the Arctic. That includes a form of missile defense, although not likely the Golden Dome that the president has envisioned, but certainly finally pulling ahead with the fighter aircraft purchase. We need to recapitalize some of the airfields and infrastructure in the Arctic. Being able to operate this time of year and later into the winter is very difficult. Minus 40, minus 60 in some instances in pitch dark. And those waters are opening because of climate change. And so this has been on the government's radar, successive governments, for some time. But it's a massively expensive undertaking as well, and something we should be doing in concert, frankly, with the Americans, but with other Arctic Council countries. And we are drawing closer to those countries, including Finland and Sweden, who are now NATO allies, and working towards this ice pack realization where we are going to build, in concert with the Americans and the Finns, more icebreaker capability.
Okay, just to pick up on another thing we heard from Donald Trump today, that NATO is nothing and without the U.S., and we've heard the rhetoric before. But I just want your opinion on whether or not NATO could stand without the U.S.
Well, they could and they would. It's obviously not preferable. And I've sat at those NATO tables, to be honest with you, and we've been hearing complaints for some time, rightly so. We were not living up to the agreed upon 2% of GDP spending on national defense. We got close. And during Afghanistan, we were punching above our weight, as Canada has done for decades, but still not really paying our way, paying the freight, so to speak. And that has riled the Americans, successive governments, including Obama, Reagan, Bush, others. But we're getting there now, or so it seems. The commitment has been made. The money has not really been allocated or even identified as yet. So there is still some skepticism about whether we're going to be able to reach that capacity. But look, NATO, it has been and continues to be the most important military alliance in global history. And Canada is a founding member. We need and want the Americans to be part of it. But attacking another NATO country would see its unwinding potentially quite quickly.
Okay, let's also get quickly to another issue, which is a trip by our prime minister to China and a meeting with the leader there. What should the Canadian priorities be for Mark Carney?
Well, I think trying to work out some sort of trade arrangement that at least sees the dropping of tariffs. They have tariffs on Canadian canola and seafood and pork. We, in turn, have put tariffs on aluminum and steel and EVs, vehicles. So working out some of that, I suspect any trip, and I've been in some of those meetings with Chinese officials, there may be talk of human rights concerns towards Uyghurs, Tibetans, Falun Gong worshippers. We've seen Canadians kidnapped. We've seen intellectual property being stolen by China. They have an abysmal record when it comes to human rights. And so those items often come up. So those discussions are delicate. But let's be clear, the trade deficits that we have with the United States, or shouldn't say deficits, we do approximately $700 billion annually. It's much, much less with China, although a lot. So there's capacity to grow, but we're never going to supplant or completely replace that trade with the United States. And again, we have to be careful and cognizant of the fact that China and the United States are on a knife's edge as well. And so we don't want to go too far in suggesting that we're going to sell them our surplus energy, which questionably we can't get to them because we don't have the necessary infrastructure. Nor do we, as we saw in the case of recognizing Palestine or coming down too hard on the side of those who are criticizing the United States, the president takes it very personally. So caution has to be part of that trip to China. I suggest we can also do more with other countries in the region that are more closely aligned, that are democratic, like Japan, South Korea, not just talking to the Chinese Communist Party.
Peter MacKay, former Canadian Defence and Foreign Affairs Minister. Let's have a quick look now at the market. The TSX edging higher in morning trading, up about 0.1%. Shopify is on our radar. We'll talk about instant gratification. They have now signed a deal the stock is down a bit, but with Microsoft. In which, if you're using Copilot, it's AI product, they now have a thing called Copilot Checkout. So if you're using Copilot, you can start buying right from the chat without going to external sites. And the partners here include PayPal, Shopify, and Stripe. Let's have a look at MDA, the satellite systems vendor. It is in line for work on the U.S. missile defense system, Trump's so-called Golden Dome. Thank you very much indeed for watching The Open. Morning Markets is up next.